Howdy, Jacob here. Today we're looking at Delek US Energy, ticker symbol DK in the oil, gas, consumable fuels industry. 1.2 billion market cap on 3 billion enterprise value. Just down the road from me, headquartered in Brentwood, Tennessee, founded in 2001. Their growth in revenue has been pretty great. They do have a lot of debt though. Their dividend currently pays out a 5% yield, pretty big, and it is pretty big in relation to their average free cash or their average earnings per share. Return on invested capital, nothing to brag about. Gross and operating margins, essentially nothing. Mid-single digit, low single digit. A balance sheet has 822 million cash on hand with 45 million short-term debt, almost 2.6 billion long-term debt. So 2 billion long-term debt is a lot in relation to their historical cash flow. More recently, you're looking at 5 to 6 years, but historically, more like 10 years. And so we'll see if they can keep these margins up or not. But if so, still even 6 times your free cash flow is a lot. But it looks like they have been heavily paying that down, the rolling 12 in the last year. It looks like other uses of cash are going to be that dividend pays out 60 mil, and then there's some acquisitions and some share repurchases. So this is going to look a little bit wonky due to their enterprise value being so much greater than their market cap. Just understand that P and price free cash flow I'm basing more off of enterprise value. But their revenue change, I mean, they've grown so much recently. This is one of those businesses, I don't know, maybe 313 makes me comfortable, except 13 is going to be quite a bit lower due to enterprise value being so much greater. Maybe we'll look at an 8 PE with margins of both so very low. I mean, I guess we're looking at decimals here, but 1.2, 1.4 seems fine to me. Share change. Recently actually issued some shares, 30 million. I mean, let's just say they keep that flat. Dividend. I mean, their dividend's all over the place. Keep that flat too. And we're saying the company's stock price needs to fall 18% before we get the return we're looking for here. This could be one of those businesses that maybe I'm just not fully understanding. A company with over double enterprise value and debt is extraordinarily unattractive to me. But the only thing that keeps me going is that the rolling 12 and last year they have focused on debt reduction. So probably wouldn't be focusing more on thinking about investing in this company unless they truly start reducing that debt quite a bit more. But I mean, interesting business and one that says it's pretty close to a buy price given these assumptions. So we'll have to see whether that's the case if it falls a little bit more. Hope you enjoy the video.